As 2023 comes to a close, I wanted to share some rules for investing in stocks and crypto. This is the first time I'm talking a bit more about Bitcoin and crypto on my channel, but since it's a part of my portfolio, I figured it's worth mentioning. I have compiled a list of 24 rules to help you navigate the world of investing better. We will start by looking at some general investing rules, then move on to the stock market, and end with everyone's new favorite asset class, that is crypto. Throughout this video, I will also highlight some of my current holdings. Let's begin. Let's start with some general rules. Rule number 1. Don't blindly believe analysts and mainstream media. While analysts can provide valuable insights, they are very often wrong. It's essential to do your own research and due diligence instead of following analysts' recommendations blindly. And please remember, the mainstream media is not there to make you money. In fact, their job is to take your attention. That can indeed translate to you losing money. When you hear analysts giving their advice on channels like CNBC, use resources like tip ranks to look at the analyst's track record. You will be shocked to see the kind of people that get platformed to cause fear among retail investors. Rule 2. Learn to control your emotions. Emotions are a huge problem in investing. Fear and greed can lead to impulsive decisions such as buying high out of fear of missing out and selling low in a panic during market downturns. In the crazy crypto markets, FOMO is the fastest way to lose money. Just like all the people in 2021 buying Dogecoin at 60 cents when it was almost peaking. Make decisions based on careful analysis and not based on your emotions. That's how you win in investing. Rule number 3. Understand your investments. Before you invest, whether it's stocks, bonds, crypto, or real estate, it's important to understand what you're investing into. A shocking 90% of traders lose money, often due to lack of fundamental and technical understanding. Don't just follow the crowd. Make sure you do your own research and have confidence in your investments. Rule 4. Take a long-term view of your investments. This is quite self-explanatory. Stay away from get-rich-quick schemes, don't gamble, and adopt a long-term perspective on your investments. For instance, the S&P 500 has historically provided average annual returns of about 10% over several decades. At least with a portion of your portfolio, you should take the set it and forget it approach. Rule 5. Learn about macrocycles. Understanding macro and economic cycles can give you an edge in your investment strategy. Macro cycles, which include periods of expansion and contraction in the economy, can influence market trends and asset prices. By understanding these cycles, the least you can do is not buy into assets at the wrong time. Rule 6. Diversify across asset classes. Diversification is a key strategy to managing risk in your portfolio. By spreading your investments across asset classes such as real estate, stocks, bonds, and cryptocurrencies, you can mitigate potential losses. While diversification is key to staying safe, for bigger gains, make sure not to over-diversify. Let your investments in the S&P 500 take care of that aspect. And when picking individual stocks, make sure you look for the winners by doing thorough research. Now let's look at some rules more specific to the stock market, starting with Rule 7. Understand the fundamentals of your investments. This involves doing a deep dive into the key metrics of the company, such as cash flow and the company's management structure. It also includes an analysis of the company's income, revenue, and growth potential. All this data is publicly available through the company's financial statements, and there are plenty of platforms where you can do your research. The goal is to identify stocks that are priced correctly or incorrectly by the market. Rule 8. Diversify your stock portfolio. This involves holding multiple stocks in your portfolio. For instance, your stock portfolio could include a mix of large cap and small cap stocks. According to modern portfolio theory, diversification can maximize returns for a given level of risk. Again, make sure not to over-diversify. The more individual names you pick, the less likely it becomes that you'll beat the benchmark. Rule 9. Value investing is important. This means buying undervalued stocks with strong long-term prospects. Warren Buffett, for example, has made a fortune with this strategy. Value investors believe that the market is inefficient and may overreact to good or bad news, resulting in stock price movements that do not correspond to the company's long-term fundamentals. That's when you scoop up great companies at lower prices. Rule 10. Invest in dividend stocks. For average investors, these stocks can provide a steady stream of income. They can also come with potential price appreciation. A company like Manulife, known for its regular dividends, could be a good addition to your portfolio. A lot of growth investors may not like this, but as your portfolio grows, consider adopting some of this approach too. Rule 11. Consider blue chip stocks. These are shares of well-established companies with a history of reliable performance. Think of companies like Apple and Microsoft. These companies have also proven that they can outlast bad macro events. You might think that these companies are way too big to make your wealth grow, but people have been saying that about a company like Apple for the last few years, and it keeps going up anyway. Never underestimate the power of a good company when combined with money printing. Rule 12. Avoid day trading. Firstly, I would like to clarify that I'm not against trading in any way, but day trading can be too much of a gamble. While it can seem attractive due to the potential of quick profits, it's also very risky and requires a lot of time and knowledge. A shocking 90% of day traders lose money, often due to lack of understanding and the ability to control their emotions during the rapid ups and downs of the market. Stick to your long term perspective, but if you want to start trading, try swing trading first. That's what I do. Rule 13. Be ambitious but don't expect too much. This is hard because we often hear of these one-off cases when people 10x their money overnight through meme stocks. You might also hear from your friends how they made 200% gains on a certain stock. Just ignore all of it and focus on your game. Investing is a personal and long-term endeavor, and you should set expectations accordingly. Rule 14. Maximize tax efficiency in your investments. This involves leveraging tax-efficient accounts for holding stocks. For example, consider investing in stocks through a Roth IRA or TFSAs to enjoy tax-free growth. Tax-efficient investing can significantly boost your returns over the years. Also, make sure to take advantage of your retirement accounts that can also help you get tax refunds that you can then invest too. Rule 15. Assess your risk tolerance. Remember, your risk appetite and risk tolerance are two different things. Just because you can stomach a lot of risk does not mean you should tolerate risking money that you can't afford to lose. This often depends on your financial situation, investment goals, and personal comfort with risk. Just make sure to understand who you are. Now let's look at some rules for investing in crypto. But before that, if you're enjoying the video so far, hit like and consider subscribing to support my channel. Now back to the rules. Before we get to that, I want to start by clarifying that to me, Bitcoin and crypto are different. Bitcoin leads the market, but it exists for several different reasons, and I'm a believer in those reasons. Looking at the world today, we should all consider holding some Bitcoin. Rule 16. Invest what you can afford to lose. When it comes to this asset class, you should only invest money that you're willing to lose. For example, you might want to limit your crypto investments to 5 to 10% of your total portfolio. Crypto swings like crazy, and I know Bitcoin does too. Again, when it comes to this, I keep Bitcoin and crypto separate, but you might disagree with this, then you should treat all of it the same. That money is as good as gone. Remember, this is an extremely high risk, high reward play. Rule 17. Assume everything is a scam except Bitcoin. We all know that unfortunately in the crypto world, scams and frauds are extremely common. To keep your money safe, it's important to approach everything with a lot of skepticism, except for Bitcoin, which has proven its resilience and staying power over time. It's the only truly decentralized network that will remain king in its use case. While there are plenty of altcoins that are not scams, it's important to do your due diligence to avoid falling for the thousands of scams. Rule 18. Not your keys, not your Bitcoin and crypto. One of the fundamental principles of Bitcoin and crypto ownership is maintaining control over your private keys. If you don't control the keys, you don't truly hold the asset. Storing your Bitcoin or other crypto in a wallet such as Ledger or Trezor is very important. You controlling the keys reduces the risk of losing your assets to exchange hacks or custodial failures. Did you know that 20% of all Bitcoin is lost and a lot of it is due to people losing their keys? Let's not become a part of that group of people. Rule 19. Understand the technology behind crypto. I will keep this short and simple. Before jumping into the asset class, take some time to understand what's really happening in this space. What is a blockchain? Why was it created? What is Bitcoin? How does it differ from other cryptocurrencies? Also understand why are there so many altcoins today? What is a layer 2? What is a layer 1? There's so much to understand in this space. At least start by understanding what is blockchain, the technology behind Bitcoin and other crypto. Understand the importance of the decentralized ledger. Bitcoin is the only true blockchain use case for many. Once you understand what's going on in this space, you'll understand whether or not you want to put money into this asset class. And please start by studying Bitcoin first. Rule 20. Diversify your crypto portfolio. Again, this is a very obvious rule. Keeping Bitcoin aside, diversifying across the crypto asset class can help you manage your risk better. Please don't go all in on Cardano or Doge or Solana or even ETH. Investing in a variety of crypto can expose you to different projects and potential growth opportunities within the new and evolving space. Rule 21. Time your crypto investments. This is the opposite advice you get for most of your investments. Due to the 4-year cycle that exists because of Bitcoin, it is important to understand that timing the market is more important than time in the market when it comes to crypto. A lot of you might disagree, but it's important to understand the cycles because the pullbacks can be brutal. For me, when it comes to Bitcoin, it's different. DCA and chill is probably probably the best strategy there. Rule 22, stay updated with crypto market trends. This market is evolving really fast with new technologies and trends coming up every day. Staying informed about the latest news, technological advancements, and regulatory changes can help you make better investment decisions. For example, understand what's going on with DeFi, decentralized gaming, and the Bitcoin ETF to stay ahead of the curve. Rule 23, consider the liquidity of cryptocurrencies. Liquidity is an important factor when it comes to investing in crypto. It refers to the ease with which an asset can be bought or sold in the market without affecting its price. Bitcoin is a highly liquid asset when compared to other cryptocurrencies, and it's easy to buy and sell out of your positions. High liquidity is also an indicator of a healthy, stable, and mature market. And finally, Rule 24. Set clear financial goals for crypto. When venturing into this asset class, it's important to have clarity in your financial goals. Decide if you're aiming to increase your dollar wealth or accumulate more Bitcoin through altcoin trades. This decision will guide your investment strategy greatly. Remember, each approach requires a different set of skills and different risk considerations. Now, a quick bonus rule that applies to any investment. Rule 25. Have fun with your investments. Remember, investing is about making money, but it's also about learning and enjoying the process as you go through your journey. So enjoy the ride and celebrate your wins no matter how small. And that's it, 24 rules to help you make more money with stocks and crypto in 2024. Remember, these are just guidelines. Always do your own research or consult a financial advisor if necessary. As we enter 2024 in less than a week, I wish you all the best with your money and investments. I hope you make a ton of money next year and your investments grow exponentially. And as always, keep learning and stay on top of your finances. Until next time.